We have a very special guest joining us in our studios, Chetan Ahya, head of global economics, co-head rather of global economics and chief Asia economist at Morgan Stanley, joins us to discuss his recent report where he's betting big on a rebound in Asian exports, helping the overall growth of the region and really leading to an inflection point from here, which can lift sentiment across Asia. Chetan Ahya is right here in our studios. Chetan, it's great to have you on the show. Let's start off with, the basic premise of this report. You're saying this rebound is very much in the works. But what's important is how critical is this rebound at this juncture when exports as a percentage of GDP, which your report highlights, within the region has come off from 2008 levels. And also global trade has been going through a major slowdown.
Look, for emerging market, exports tend to be a big important driver of growth, because what happens is in the last 5 years since credit crisis was going on, everybody is trying to stimulate domestic demand with leverage. North Asia, as well as what we saw in India, the government initially was running high fiscal deficit, but it was essentially leverage driving growth rather than productivity. And so right now, all across, we've got in places like India, the corporate balance sheet is impaired because of the debt problem, as well as in the other parts of region, North Asia, debt to GDP is quite high in the private sector. And so if you get this exports recovery, what then helps is to help these countries to rehabilitate their balance sheet. So it is quite critical to get this exports recovery at this point of time.
Just taking a look at the report in terms of which countries would likely benefit, and it's been clearly highlighted that some of the countries that suffered from the debt disinflation challenge would be bigger beneficiaries. If you could just elaborate a little bit more on that.
So look, I think if you look at China, for example, which is a big component of the North Asian countries suffering from debt deflation problem, they have been operating very strong counter-cyclical growth model. So when exports are weak, they try to create domestic demand with capex. Now that tends to be very counter-cyclical from growth management perspective, but very pro-cyclical from debt management perspective, because you created this capacity, which has then resulted into pricing power problems. So PPI wasn't deflation, and therefore weaker nominal GDP growth and persistent rise in debt to GDP. So China's total debt to GDP over the last 7 years has gone up by 132 percentage points. Now that's a big rise in debt to GDP while trying to manage this growth cycle, because exports never really came back. And this is the first time where we are now seeing exports recovery, which we think is going to be quite sustainable. So as that comes through, your past capacities which you have laid down in form of excess capacities will get better utilized. And because you have external demand, you will hold back on further capex and domestic demand push through leverage. So it will really help them manage their debt to GDP much better. And right now, as we think from investors' positioning perspective, they are quite underweight on China. So which is why we highlight North Asia as bigger beneficiary. China's investor position in GEM's portfolio is at a 10-year low. So investors have been quite concerned about this debt problem in China. Therefore, we are highlighting that to be a bigger beneficiary.
And this is Maithili, as I said, from the Noida studio, and it's great to have you with us. But I have just one fundamental question, that while it's very good news that exports are recovering and export recovery is very critical, the entire premise of the recovery is based on the US not going in for aggressive protectionist measures. Now, from what we've seen of President Trump after he's taken over, there's very little to substantiate that belief. On the contrary, we've seen Trump take pretty protectionist measures. So how come you're so hopeful that this recovery will be sustained? I'm not.
Well, so look, that is a risk for sure. But I think, Maithili, before I get to the protectionist risk, the key reason why we are constructive on external demand is that DMs are not deleveraging anymore. And it's not just US. So if you look at US, Europe, and Japan, all three of them have nearly reached a position where they're either not deleveraging or releveraging. So that's the first point. And then in terms of evidence of that, as we speak, before we can talk about protectionist measures, real imports out of all the three DMs are accelerating at a very rapid pace. So exports recovery is not a forecast, it's actually already happening. And so that's the first point. And then the second point, in terms of the protectionism risk that you are asking, look, I mean, just see how they have handled the Mexico issue. That was the big first issue to be addressed. And what they're saying is they are going to renegotiate the treaty with Mexico and the whole NAFTA treaty. It's not that they are just going ahead with some ad hoc measure which is protectionist. So what we want to see is whether the protectionist risk is emerging out of the US by US taking something unilaterally as a step which is big and restrictive. And right now what we think is that the protectionist measures will be more moderate. So for example, if they take up anything between like 5 to 10% import tariff, you could see some currency depreciation in EMs, and they could put in an additional incentive in form of export incentives, and you would probably be able to negate that significantly.
So you don't read too much into Trump pulling out of the TPP, as also the fact that the word protectionism, the end to protectionism, was dropped from the G20 statement. You don't read too much into that. You think it's just rhetoric?
No, it is rhetoric in broad sense, and it does mean that there will be a slowdown in further progress in globalization in terms of trade deals signed by the US. But at the same time, we have to question whether the problems in exports that you saw in Asia, what is the big reason for that? And the big reason was that DMs were actually going through a big challenge. DMs account for 60% of EM's exports. And so that is the first factor that we should consider when we're thinking in terms of the outlook. Yes, there could be friction caused by some additional protectionist measures to be taken by the US, but will that take away the overall exports recovery story? I also looked into the Japan development in the 80s when the US was taking up similar protectionist measures. And because the US was actually growing strongly and domestic demand was strong at that point of time, actual exports out of Japan to the US were held up pretty well even in the 80s when the US was taking the protectionist measures. So domestic demand impulse in the US will, we think, be more important measure to watch rather than the protectionist measure, unless there is an aggressive protectionist measure, which is like, I would say, something like a 20% import tariff by the US, which is almost put unilaterally. That would be disruptive for global trade. But if it is a small tariff or it is renegotiation of trade treaties, it will not be an aggressive step which will take away the export story for Asia.
Right, and Chetan, how are you qualifying the deleveraging that you're observing in developed markets? Because at last count, we were talking about how debt in the United States is reaching $20 trillion. It's doubled almost from 2010 levels. So how do you kind of qualify that, we are at the end of the deleveraging cycle, whether it's corporates or whether it's at the retail level?
So, well, when you think about the leverage cycle, what you want to see is what is happening to the troubled balance sheet. Look, government debt to GDP is not really a constraint for growth cycle. What really tends to be a big constraint is the private sector, because if the private sector is in a default mode, it's in a repair mode, then you don't see that vibrancy in the private sector risk attitude, and that just holds back the whole cycle. And so that's what we were going through in the US, and the most important balance sheet in the US in that context was the consumer balance sheet. And they were deleveraging until the second quarter of 2016, but now they are back. They are back into releveraging mode. And so as a result, the aggregate private sector balance sheet in the US is now on the releveraging mode, which is itself showing up now in form of stronger imports from EM, which is sort of the basis of our exports recovery theory.
Chetan, as far as India is concerned, there's this general view that the export-led growth that the East Asian tigers experienced during their growth phase, that is effectively over. And we cannot really hope for export to be the driving force of our growth. It has to be domestic demand. So will this recovery in export, even if it does happen, and even if it is sustained, how much will that help a country like India? Will it be only at the margin?
No, I would say that would be a very important driver to India's growth recovery going forward. Because see, typically what happens in EMs, and that's also what happened in India, is that once you have gone through a phase of adjustment, which is where you run very tight fiscal and monetary policy, pull back your domestic demand, and improve productivity dynamic, at that point of time, your corporate balance sheet is impaired. And right now, we even also have the SOE bank's balance sheet, which is impaired. So you need that growth equity, which comes in from exports, that helps you improve capacity utilization and give you that equity of growth which doesn't need leverage. And so export plays a critical role at that time of adjustment which goes through in EM, and it's also happening in India. So we think exports is very important. And by the way, not many people realize that India's exports to GDP is now same as China at 20%. So it's not small. And what we had gone through in the preceding 18 months is not that exports were not really supporting growth, but they were actually a serious drag. And don't think of exports problem as just exports problem. What was also happening is we went through a major compression in pricing power in the corporate sector because of the global disinflationary pressures. So think of both these factors taken together. That was actually affecting the overall corporate sector profitability in a big way. So now what we're expecting is some kind of normalized exports growth. It doesn't need to be big, but just doesn't drag the overall corporate sector profitability. alongside improvement in pricing power, which is also what is already available for us to see in the WPI data and manufactured products pricing power. That will therefore help us rehabilitate the corporate sector balance sheet and therefore overall growth environment.
Well, yes, our share of exports to GDP is certainly higher than it used to be a couple of decades ago. But the fact is that India is not part of the global supply chains at all, unlike in the other names of the other countries that you mentioned, which are likely to benefit from the export growth. In fact, the global supply chain is largely out for us. We're no longer, we can't possibly get onto that boat right now, and the rest of the world has taken over on that. So how will we benefit, whereas China, Singapore, all the East Asian tigers are part of the global supply chain, which also in fact is in danger of breaking down, with Trump saying that please make in America. We've seen in the case of the Dakota pipeline, etc., that he said that even the steel for the pipeline must be completely sourced from start to finish from within the US. So my question to you is twofold. A, India has lost out of the global supply chains. B, these global supply chains, are they really as effective today as they were before?
So, ceteris paribus, everything being constant, take us back before 2006, whatever we were in terms of global supply chain participation, that remains and that's not gone. With just that being stable and you get a domestic demand impulse in DM which is better, or kind of call it more normalized, I don't think we should take the last 5-6 years as normal. Last 5 years, exports growth in India is minus 2.2%. That's not normal. So if you get some normalized recovery because of the demand impulse in the DM, not because of market share gain, then that just becomes a additional benefit to the India's overall growth story. Remember that post that adjustment that we took from 2013-14 taper shock, India was actually already recovering, consumption was recovering, and then you had this massive external demand shock as well as pricing power problem in the corporate sector, and then we had demonetization problem. So now as both these things go away and you get some normalized export growth, not because of market share gain, but just because of the domestic demand impulse, you can export the same old stuff which you were part of the supply chain, whether it is textiles or footwear or engineering exports, and that will help you to gain that overall growth momentum in the economy with improvement in capacity utilization, pricing power, and then eventually in 2018, in fact, we think that if exports continue like the way they are growing right now, you probably even see pickup in private corporate capex.
Okay. How much of this story is led by a fall in currencies? Because in that case, you would also see competition coming in from Europe. The pound is at a multi-decade low. You have the euro, which is talking about parity with the dollar. And I would imagine that a lot of countries would want a weaker currency. We've already spoken about how the US is happy that the dollar is eased off a bit from elevated levels. So wouldn't that kind of eat into what may be a growing market share for Asian exports, because there would be so much currency competitiveness?
Well, that's possible, but at this point of time, because of the way you have seen broadly dollar strength, the currencies in EM have been weaker, including India. So I don't think currency is at this point of time a big challenge in terms of competitiveness. And look, I think there is a question on India's currency competitiveness which arises because if you look at the real effective exchange rate, it is significantly higher. It's almost 1 standard deviation higher than the 10-year trailing mean. So people do get concerned about currency overvaluation in India, but I think we should not just consider currency on the basis of real effective exchange rate trend compared to past, but also consider what's happening to terms of trade. And because terms of trade has improved significantly, we think currency at this point of time is fairly valued and it's not a concern in terms of export competitiveness.
Yeah, just something that I wanted to talk about as well. Do you think that, the kind of move that we've seen is perhaps unwarranted if you look at it among how it stacks up with some of the other emerging market currencies right now?
Well, I think it's primarily because what's happened to the dollar against EM. So what has happened is all the high real rate EM economies have actually appreciated against the dollar in the last few weeks. And that's because of the fact that there is no big expectation of US 10-year bond yield spiking up further from here, which initially was a concern to investors because there was a talk of US taking up big fiscal easing. But with what's happening politically in the US, that expectation has been pared back. And it is in that context is where EM's real rates, which are already high, those high real rate economies are looking attractive. And so it's not just India specific. If you just look at even the Brazilian real and Russian ruble, all the other high real rate EM have seen appreciation in currency.
Chetan, as far as your report speaks about consumer goods and capital goods benefiting greatly from the improvement in exports. But India's interests are not really in export of goods, more in export of services. And there I'm not sure I saw anything very much as far as export of services is concerned. In fact, IT, as far as IT is concerned, they're not very hopeful at all. In the outlook for service exports, where we have comparative cost advantage, doesn't seem too bright. So what is your prophecy for services exports from India?
I'll come to that in a second, Maithili, but you should not write off goods exports as a non-event for India. In fact, today, as we speak, total exports to GDP is 24%, 15 percentage points of that is goods. So goods is a critical and a majority component of India's exports as yet. Services, I know, was an important growth contributor, but lately we have not been seeing much market share gain in services exports. And so I think it's important, but it's not the only driver to India's export story. And on services, look, you just plot YOY growth rate for goods exports and services exports in India. It's moving completely in tandem. So whatever happened to global demand for India's exports to goods is also what has happened to services. And so as you expect that recovery in external demand, it's going to benefit both goods and services. I personally think that the recovery in goods is more beneficial to the economy at this point of time because we have a capacity utilization problem in the manufacturing sector and we have a problem of pricing power in the manufacturing sector, and we have some kind of a challenge with that twin balance sheets of SOE banks and corporate sector balance sheets, which really gets addressed with this recovery in goods exports.
And finally, Chetan, how does your thesis hold in a rising interest rate scenario? In the US, clearly, but you have other economies also which are doing a rethink. So, Europe is in a bit of a pause mode, likewise for UK. Turkey's raised rates. And in India as well, we've kind of scaled back on our expectations that, perhaps a rate cut going forward from here is a no question. So, in that light, because typically in a rising rate scenario, the compromise comes in on productivity and growth at the peak of the cycle. That's what we saw in 2004 to 2006 as well. So how does your thesis work in terms of the momentum that growth can keep up?
So just trying to understand, this question is really in terms of how the US is hiking, how does EM do well, or?
No, just global trade, because you're expecting global trade to move from 3.1 to 3.6% by 2018. And we're also in that light going to be looking at 3 rate hikes this year and perhaps a more aggressive stance towards rates in 2018. So followed by the US, the world moving into a rate tightening scenario, how would that impact global growth?
So look, I think at this point of time, from a broader global economy perspective, these hikes in rates are not necessarily bad news. I mean, for some assets, like for example, bond market, it's bad news. But from a global macro condition perspective, it's basically because the economies are in a better shape that the central banks are thinking about increasing policy rates. So we think it's not necessarily bad news. It's not at this stage where the central banks are really clamping on the growth cycle and leaning so hard that's actually going to result into a slowdown in growth, which is sort of our basis. We think that the global cycle is still intact everywhere, including the US, and US is the most advanced, and we are watchful of that risk of US business cycle ending. But at this point of time, we still think that there's still some time to go for this business cycle before we start worrying about the end of business cycle.
Okay. Well, interesting report, Chetan, and thanks very much for discussing that at length with us. Maithili, thanks very much for joining into this discussion. As always, pleasure having you on the show too.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.